Good evening, traders. A very warm welcome. I am Devang Mehra from the Financial Analyst, and I welcome you to the Bold Project. In this video, we'll talk about what are the different type of traders that you can be in the market. You as an individual have a lot of options. You can trade in the commodities market, forex market, equity market, derivatives market. The opportunities are cryptocurrencies there now. So the opportunities are vast. You can trade in any one of them. The concept of technical analysis that we will cover with you will remain the same. All the concepts are applicable irrespective on every market. At the same time, there are different time frames involved. So in this video, what we'll discuss is we'll discuss the basics of what kind of a trader can you be depending upon your psychology as a person, depending upon how you like things as a trader. So let's get started so that things will make sense to you. So let's say this is you, and there are 3 to 4 different type of people that you can be. The first type of a trader is called a person who does long-term investments. I'll give a very simple example. Someone like Warren Buffett, he buys a stock, and what does he do? Does he sell it the next day? Does he sell it the next week? He doesn't. He buys the stock, and I quote, he marries the stock, and he'll probably sell it in 10 years, 20 years, 30 years. That is called long-term investment. So you might want to buy, you might want to think that Reliance is a very good company. You want to buy Reliance and hold it for 1 year, 2 year, 5 years, 10 years, and marry the stock. That is called long-term investment. The thing about long-term investment is it's obviously the safest approach when it comes to the markets. So if you're talking about the financial markets, the long-term investment will be the safest option for you. Why? Because you have so much time. You enter a stock, let's say Reliance at 2000 rupees. Even if the stock goes down today, it doesn't matter. Why? Because you have decided to hold it for 5 years, 10 years, 15 years. So it won't matter what it is doing today, this week, next week, even this month, because that time horizon is too big. Hope that is clear. So in long-term investment, you can only be a buyer of the shares. What I mean by that is, how can you make money as a long-term investor? You will buy a share trading low, and then you will sell the share when it is high. That is how you make money. So you are expecting that this company is going to go higher. So if you think a particular company is going to go lower, you can't buy that company. You will think it's going lower. So you will basically destroy your capital. So in long-term investments, you as an investor can only make money by buying a share which is trading low and then selling that share at a higher price. So what I'm trying to say is, if the markets are about to crash, you can't immediately short a share and make money. Shorting a share means that if the markets go down, you make money. So in long-term investment, you can't do that. So if you have bought a share and you are holding it and the price falls down, then you're probably losing money. As simple as that. Why do people do long-term investment? It is very simple. There are two reasons primarily. The first reason why people do long-term investments is because of capital appreciation. So if you've invested, let's say 1 lakh rupees in Reliance and you hold it for 10 years, that 1 lakh might become to 2 lakh rupees. So your capital is increasing. It is appreciating. Your wealth is accumulating. The other reason why people do long-term investments is because of dividends. Dividends is basically a free return that you get from the company for being a shareholder. It's so after every quarterly results or after half yearly results, the company, if it is performing well, if it has a good cash surplus, and it feels like it wants to reward the shareholders, so it wants to reward you as a shareholder, as the owner of the company, so they can distribute some kind of dividend, they can distribute some kind of profits to you in the form of dividends. So these are two ways that people can earn money in the markets by doing long-term investments. The only thing is that only in long-term investments you can be a buyer in the market. The other way that you can make money is by something we call a swing trading concept. What is swing trading? Long-term investing was holding for a long period of time, maybe more than 1 year, 2 year, etc. Swing trading means that you want to take advantage of some kind of a swing in the market. I will show you an example of what a swing is. For example, this is the charts of Nifty. You can see that the market started going up like that. Over these 5-6 days, market immediately went up. This is called one swing. Sorry. Another swing you can see when market went up like that. That's another swing. This over here is another swing. So whenever market gives you a short-term momentum, maybe for a couple of days, maybe for 2-3 weeks, 4 weeks, 1 month, that is called a swing. You are basically being a momentum trader. You see a momentum coming into the stock. You want to get into the stock, hold it for a couple of days. You've got your 5-10% return, and then you get out. The difference is that in swing trading, you are not coming in for dividends. You are just coming in to get that short-term return, get your capital appreciation and get out. As simple as that. That is what I call swing trading. So in the groups, you will hear us saying that hold something on a positional basis. That basically means swing trading. When I say positional basis, doesn't mean long-term investment. Long-term investment will be clearly mentioned that buy Reliance for long-term. If I say buy something for positional, it means buy it today, let the momentum come. In a couple of days, in a couple of weeks, you will sell it once you get that momentum. That is called swing trading. Again, in swing trading, you can only make money how? By buying the asset. So if you have to buy low, get the momentum, get the share price higher, and then you sell the price. But let's say if you bought the security and markets went down, you will lose the money. You can't short a stock by doing swing trading. So just like your long-term investments, the only way you can make money is by buying the share. I hope that concept is clear. Now, the concept after this is something I would like to mention. It is called BTST. Buy today, sell tomorrow. Why am I covering it separately? Is because I will give you some trades in the group on this concept. I love to do BTSTs. BTST means you buy today and sell tomorrow. How I do BTST, I will do a separate segment because currently you won't understand the concepts. How I do it, it will be covered in the price action trading module. But BTST means maybe today at 2 o'clock, I see some kind of big move happening in Reliance. I'll give a very simple example. I'm keeping the example same of Reliance. Let's say at 2 o'clock or 2:30 p.m., you get a news in the market that Google is going to invest some money in Reliance. You get that news, so obviously it's a favorable news for Reliance. So what will happen is that Reliance stock price will be going higher. But do you think you have a lot of time left? Indian markets are open from what time? 9:15 to 3:30. Correct? So you have only 6.5 hours to trade roughly. So if you are getting a news at 2 o'clock or 2:30, you only have 1 hour left to trade. And you know very well that this news that has come in is going to have a very big impact on the company. So you want to buy Reliance at 2 o'clock, but you know you can't do intraday. You know that this impact will be holding for 1-2 days. What you will do is you will buy at 2 o'clock, and when will you sell? Tomorrow. Buy today and sell tomorrow. So when I say BTST, you are buying in the later half of the market and you are selling at the open. That I feel is very important. A lot of people do hold it over, but when I say sell at open, that means whenever you buy, I don't care. But tomorrow when the market opens at 9:15, you exit the stock. Why? Because that overnight must have given you the momentum. Very simple. Another example, some positive news comes at 2 o'clock, comes at 3 o'clock. I'll give us another example. Some news, let's say a company like Pfizer, at 3 o'clock in the Indian market standard time, you got a news that Pfizer is coming out with a vaccine for coronavirus. So you know very well that this is going to be an explosive move and Pfizer share will go up at least 5% or 10%. But you know that today I can't trade this. Why? Because you have only half an hour left. 3 o'clock to 3:30, that's the window that you have. You can't make money in that window. You know that if I hold this stock, it is going to give you a very big momentum. So what you can do is you can do a BTST trade. It's a normal trade, like you will execute this trade just like how you execute these two trades. It is exactly the same, but just the mentality is different in the sense that you buy it at 3 o'clock, you immediately sell it when at 9:15 in the opening. You would have got your adequate profits. Why? Because of that positive news, the next day market will not open flat. It will already open gap up. So overnight holding, you have already got that profit. So I will discuss more into this concept in that price action trading module. So we'll do a lot of examples there. My main purpose for this video is just to explain what different types of traders that you can be. So you can also be a person who is a BTST trader. You buy today, sell tomorrow, buy today, sell tomorrow. So, but obviously for all of these three order types, you will need some capital. So if you are a student starting out your journey in the markets, I don't think you will be able to do a lot of this. Why? Because if I want to buy shares of Reliance, one share of Reliance is 2,000 rupees. So if you have a capital of 10,000, you can only buy 5 shares, right? So you can't basically buy in bulk. At the same time, if you're doing a long-term investment or even a swing trade and your capital of 10,000, when it is entirely locked, you can't trade anything else. You are fully exhausted. So that is the reason these three order types are done by those people who are already, established in the markets, who have a sufficient capital to abide by in the markets. So now there is a order type that I call intraday trading. That is one person if you're a student, that is something that you are probably already doing as I speak. So let me explain what is intraday trading now. So intraday trading is also called MIS, margin intraday square off. You have to understand what it is, because most of the people you're watching right now have come to me for intraday purposes. Intraday trading, what happens is our Indian markets time are 9:15 to 3:30. These are the times when the Indian market trades. So in that short term trading, swing trading, BTST, what are you doing? What is common? The common aspect is that you are buying a stock, holding it, and you will sell whenever that you want. But the main thing is you are buying a stock, you are taking the delivery into your demat account. So when I say buy a stock, you are buying a stock, and that the stock, it comes to your demat account, right? With your broker, it comes to your account. In intraday trading, the thing is you are not taking delivery of the stock. You are taking, it's basically like you are taking a loan from your broker. I will try to tell you as simple as possible. Let's say I want to trade Reliance. In intraday trading, it means that you have to basically square off your position in this time frame. If I am buying Reliance, let's say at 9:15 in the morning, I have only 6 hours to trade. Otherwise, it will automatically square the position off. Does it make sense? Let me give you some more examples. In intraday trading, you have to square off your positions on that very single day. You can't take something overnight. So if, let's say, I am buying, and in intraday, another thing before I forget, you can not only do buying, but also you can do what we call shorting or selling. I will explain everything in detail even in the next video, order types. Just get a hang of this. So in intraday, let's say I'm buying right now. So when I'm buying, this means I have only 6 hours to take advantage. Otherwise, I'm stuck. Now, what happens is, let's say I'm buying the share of Reliance currently at 2,000 rupees. That's the price I buy Reliance at. So if Reliance goes, let's say, to 2010, I will make money. Now, the condition is you can't hold it overnight. You will have to compulsorily sell it also by 3:30. If you don't sell it at 3:30, the broker will automatically sell it, automatically square it off. Why? Because when you were entering the trade, you selected intraday trading, and your broker was intimated that you were not taking delivery of the stock. You were not getting that stock into your demat account. You just took a mere loan from your broker. You traded the stock and then returned the stock back to the broker. So this 10 rupee profit that you made by buying and selling, this is an intraday profit, and basically it comes to your account. Concept is exactly the same, but in intraday, the main thing is whenever you enter a trade, you have only 6 hours. So let's say you enter a trade at 2 p.m. You have to sell it at 3:30. You cannot hold it above that. If you hold it above, after that, it will automatically sell. So let's say Reliance we bought at 2,000, and let's say Reliance went to 1,990. So a lot of people ask me, can I still hold the stock overnight? You can't. By 3:30, either book yourself a loss, or automatically the broker will book your loss. So automatically it will square off. I hope this concept is clear. This is what I call intraday trading. So the question is, why do people do intraday trading? There are two reasons. The first reason is that not only can you buy, but also now you can sell a stock. Selling a stock, what does it mean? Let's say I'm expecting the markets to go down. So can I make money in the markets in the other sources? I can't, because in all the other options that I discussed with you, I can only make by buying low and selling high. But what if I know another lockdown is coming? What if I know Modi is announcing a lockdown and things are going to crash? You can in intraday sell equity also. That means, so for example, if I sell Reliance at 2,000 rupees, I am currently not holding Reliance. Please don't get confused. I am not holding Reliance. I just click on sell Reliance at 2,000. And now if Reliance goes down, that will be my profit. That is my profit. If Reliance goes up, that is my loss. So this is the concept that is there. Yes, in positional trading also, you can do selling, but that is only available in derivative segment. You can't do positional selling in equity. So we are concerned about equity. So if you think markets are going to go down, then you can come to the intraday trading system, and then you can sell that stock or sell whatever asset you are trading. I hope the concept is clear. So not only can you buy, buying in intraday means you are buying a stock, and if it goes higher, you make money. But the time limit you have is only till 3:30. Selling a stock means I'm not holding the stock. Shorting, I'm not holding the stock. I think this stock will go down. I short the stock, and if it goes down, I make the money. So both the things are possible. In shorting the stock, if you short and it goes down, you make money. But if you short and the stock goes higher, then you lose money, because you were expecting market will go down, but if it went up, you lost the money. Same is the case with buying. If you are buying a stock, it goes higher, you make money. But if you're buying the stock and it goes lower, it is against your analysis, against your assumption, and you will lose money in the market. Hope it is clear. And finally, why people do intraday trading? Number one is because they can short the stock also. Number two is because they get margin by the broker. What is margin? It will be exactly clear in the next module, because I will be showing you a practical example on how we execute orders on the Zerodha platform. But just to give you background, margin basically means that the broker is giving you more surplus cash to trade. So just to give that same example, you have 10,000 rupees in your bank account. So if you want to buy a stock of Reliance, you can only buy 5 shares, right? Because you need to have the cash to hold it overnight. If you want to be a long-term investor in Reliance, you have to give the cash to your broker, and then only the broker will give you the shares. So you need that hard cash. But in your intraday trading, it is called margin intraday square off. I've already explained what is square off. It is already things will get squared off at 3:30. Margin basically means that now you have a cash of 10,000, right? Your broker will say this keeps on changing depending upon the market volatility. Your broker will say, do one thing, Devang, I know who you are. Let me give you some more cash. So rather than trading with 10,000, your broker will say, I'll give you 5 times margin. Now you can trade with 50,000 rupees. So in margin intraday trading, the benefit is rather than trading with just your own cash, you can also avail margin. It is free to use. The broker only charges, I think, 20 rupees in Zerodha. In the other discount broker, also 20 rupees. That's not a very big amount, but there's no additional charge of availing the margin. It's an inbuilt feature. You can avail it, you can't avail. If you don't want to, you don't avail it. That's up to you. But margin means that depending upon volatility, if it's 5 times, 10 times, the broker will say, okay, you have a capital of 10,000, take some more cash from me and trade. So now I don't have to trade 5 stocks of Reliance. Now, because I have 50 stocks, I can trade much more than that. I can trade like 20 stocks of Reliance. So with margin, I have a much more surplus of cash to trade with. So what we'll do is in the next module, I will discuss the order types. So I think then the entire concept of margin and squaring off will be very clear to you. So I hope you understood what I'm trying to tell you guys. There are these 3 different types of traders that are possible. You have to decide what you are comfortable with, but it goes without saying, if you are a long-term investor, you are in for safer returns. The returns will be less. But if you are a short-term trader, then you are in for the risk. You want that adrenaline. So you will be doing a risky trade, but wherever there is risk, there is more return also. That's it for now, guys. Thank you so much for watching.